Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about some stocks and companies that have been commented down in the comment section that you all wanted me to review. So we're going to start off reviewing QuantumScape, which is an electric vehicle battery manufacturer, and then we're going to move on to our next company, which is going to be none other than FuboTV, which is a streaming service that specializes in sports streaming, and then after that we're going to conclude by reviewing a healthcare company called Invitae. So if you have any other ideas or comments about these companies, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, I say let's jump right into today's stories. So we're going to start off talking about QuantumScape. Ticker symbol is QS. Right now, the QS share price trades at $6.70, while professionals in this area believe the company should be trading between the range of $4 and $25. And clearly the current stock price and share price falls right in between that range on the lower end of that spectrum. QuantumScape is one of the leaders in the development of solid-state lithium batteries, and it's a stock that's been on many investors' watch list. The reason why it's on someone's watch list and they haven't bought this company yet is that even though there is tremendous growth potential for this company due to their solid-state battery technology and the amount of patents and technology they have, they are a very risky company, and this is what I mean. So far, the company has dropped in their share price by 80% since its peak, and it's still falling. But some investors believe that it's somewhat undervalued right now, and that's why they are purchasing more shares. With that said, if QuantumScape, remember it's a big if here, if QuantumScape is able to produce solid-state batteries at scale, this business would truly have absolutely fantastic growth overall. So now let's go over to their website to see what their website says. It says that they are building the best batteries, and this is somewhat arguable, but overall their technology is pretty good if they can manufacture it at scale. The website says that QuantumScape is on a mission to transform energy storage with solid-state lithium metal battery technology. The company's next-generation batteries are designed to enable vehicles to support the transition away from legacy energy sources toward a lower carbon future. So overall, a lot of investors like what the company is doing, but can they mass-produce their technology, and is their technology technically working? Well, right now, they're sitting on around 12 years of research and development while also having over 300 different patent applications for their solid-state battery technology. This will allow vehicles to go further per charge on top of the overall battery lasting longer in general, and many investors believe that this company could do that. But in the meantime, I don't think that QuantumScape has actually proven itself, so at minimum it's not a buying opportunity, and at maximum it should only be on a watch list as of right now until the company can prove it can mass manufacture this type of electric vehicle battery, because so far they really haven't proven themselves yet in terms of their overall capabilities and capacity regarding their technology. So I think that the risk to reward ratio is too great for this stock, and it should just be held on a watch list for now, and I wouldn't advocate to buy this company, but always make sure to do your own research and to see if you're comfortable with this company. After that, we're going to talk about FuboTV stock, which is right now hovering at $2.65 per share, while analysts believe at minimum it should be worth $4 and at maximum it could be worth $6 over the next 12 months. FuboTV has been on a great trend of increasing their overall subscriber count at very good rates. Like I said earlier, this is a sports-centric streaming service, and that's what they're known for. They specialize in sports streaming. The company also delivered very impressive third quarter financial results, and they actually beat Wall Street's expectations. And the reason for this is that their overall North American subscriber count grew by around 31% year over year, which is absolutely amazing, and many professionals as well as investors believe this company has massive growth opportunities ahead of it if they can continuously scale their subscribers. In my opinion, I think that this company is decent, but the competition is out of this world for the streaming space. For instance, FuboTV is rubbing shoulders against Alphabet's YouTube, Walt Disney's Disney Plus, on top of Hulu, as well as other streaming services. Now, what I do like about the company is that Fubo TV has a very simple business model. Essentially, it shows various sporting events on their streaming platform, and they make money from their subscriptions and or advertising. And then they use this money to reinvest back into broadcasting rights to stream more sporting events. So clearly, this is a good business model, but can they obtain a large chunk of the overall market? And I think that is more questionable due to the amount of competition, fierce competition, that they are experiencing in this space. The good news is that Fubo TV significantly outperformed Walt Disney's cable networks, on top of ESPN's ad revenue falling 23% year over year, while Fubo TV is actually scaling their overall subscribers and revenue, and that's really good to see. The fact that Fubo TV is still growing amongst their competition is good, because it's saying that they are achieving and obtaining a good amount of market share as long as they continuously grow. Their advertising is pretty on point, and it's indicative of its overall subscriber count as they keep getting and obtaining subscribers. Once they stop gaining subscribers, their overall revenues are going to stop, and this is going to be catastrophic for the overall company, but in the meantime, they have been doing very good in this regard. So those are the reasons why you might want to buy the company, but let's get into some reasons why maybe you shouldn't buy the stock. So first off, as always, Fubo TV is unprofitable, and in my head, that means the company is unproven right now. They are not a profitable business. Now, that's not saying that all unprofitable businesses are not good or haven't proved themselves, but I am not impressed with Fubo TV as of right now. Fubo TV reported a net loss of $410 million, which is actually worse than what they brought in last year, where they only had a net loss of $271 million. So clearly their net losses are increasing and not decreasing, and that's clearly what we don't want to see. Another problem with this company is that they recently closed their Fubo TV sportsbook business, and this ended up as a disaster, which I originally thought was a pretty smart idea for the company, but they somewhat overexposed themselves to too much debt and risk by doing this, and it just wasn't making them money. They were losing far more money than they were making, and they ended up closing that part of their business. Fubo TV's operating loss is not much of a reason to invest into Fubo TV either, and many professionals believe the lack of profitability and their overall losses increasing is why the share price has fallen by around 90% just over the last year. So maybe right now wouldn't be the best time to buy this particular streaming service due to the fierce competition, the fact that their operating losses are increasing, and that they are not profitable yet. Maybe another streaming provider or service could be better in your portfolio. But again, if you are comfortable with the risk to reward ratio, always make sure to do your own research on this company. Up next, we had a subscriber saying that they wanted me to review another company named Invitae. And again, another very risky stock. All of these stocks on this particular list are very risky. Currently, Invitae's share price is trading at $2.64, while investors believe the company should be worth anywhere between $1 and $4 over the next 12 months, and of course, it's meeting that particular criteria. Invitae, ticker symbol NVTA, is a genetic testing company that's still in its early growth stages, so investors are thinking to themselves, maybe if I can identify a company in its early growth stages, it's going to pay off greatly in the future. And yes, that is technically true. If this company actually makes it and does not go out of business, this could have extreme growth. But why take the risk right now? There are so many companies that come in and out of business or are just not profitable, on top of just not moving their share price very effectively. On top of that, the company, if you look at their fundamentals and financials, is burning through an excessive amount of money, which is very high risk to investors. So why is their cash burn a risk to investors? They're not technically risky in the sense of they might go out of business because of their cash burn. The real problem here is that if they do not generate enough revenue, they're creating more problems for themselves, because they're either going to go into debt through financing, or they're going to be forced to issue more shares to keep money coming in, which is going to result in significant significant shareholder dilution. This is going to be catastrophic for current shareholders if they already own this company. By increasing the number of outstanding shares on a percentage basis, this is going to be catastrophic for the gains of investors and actually work against them to where instead of gaining money, they are losing money due to the share dilution. On top of that, investors don't like share dilution and they end up selling their shares if companies end up doing share dilution and going that way to raise capital. So with Invitae's overall share price dropping by 82% since the start of the year, this lower share price could mean that it's less risky now because it's already lost so much value. But to add to this risk, if they end up doing share dilution, this would be devastating for investors. So you may want to identify another healthcare stock like, I don't know, United Health is one of my favorites to invest in during this particular time. Now, I'm not calling any of these companies on this list technically a bad investment. I'm just saying, as of right now, the risks clearly outweigh the reward. There are some exciting, great growth opportunities in the area of genetic testing where Invitae is making their bread and butter, as well as electric vehicle batteries on top of streaming services. But if these companies can't improve their financials, they may not be able to reach their full potential. They'll either dilute shareholders so much that their share price isn't going to move upwards, it's only going to move downwards, they'll take too long, or they'll never reach profitability. All of these companies have significant growth potential, specifically Invitae, because it's such an innovative field, but when push comes to shove, there are huge risks involved here. So investors could likely be better off just to wait and see what happens with these companies before they decide to invest their hard-earned money. But I would love to hear your thoughts down below. Remember to go and smash that like button for more honest news update videos just like this one. Subscribe if you are new, and I will see you in the next YT video.